Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with Dave Sayers, the CFO at Maine Savings Federal Credit Union. Dave and I discuss how he thinks about balancing the balance sheet between liabilities and assets, a pretty important topic in today's day and age with recent developments. We talk about the opportunity for credit unions to maybe pick up deposits in this time of uncertainty. We also talked a lot about how to manage liquidity, and also while you're managing liquidity, make sure you're available to meet the lending needs of your members, and also the opportunity for relationships and serving your members, putting their needs front and center to really help you strengthen brand loyalty and stickiness of customer relationships and hopefully deposits over time. I think it was a fascinating conversation. I really enjoyed it, and I hope you will also enjoy this conversation with Dave Sayers. Dave, welcome to the podcast, and thanks for making the time to join us today. I really appreciate it.
Thanks, Jeff. Glad to be here. Appreciate the invite.
I start many of my podcasts by asking my guests this question, and so I'd love to get your answer. It's like, how did you wind up in the banking credit union space? I don't feel like this was the childhood ambition of many of my guests, and yet here we sit. So tell me a little bit about your journey to where you're at.
Yeah, sure. Came over to the United States from England in 1981 and finished my college career here in Maine in 1987. And after my freshman year in college, I started actually in the banking industry. I had a job working in an ice cream parlor in high school. My mother said, no more of that. We need you to work in a nice business office. So I applied and got fortunate enough to get a teller job at a bank. And I continued to work at that institution through the next several years as it went through a number of mergers. Ended up being Fleet Bank before it became Bank of New England. Bank of America, and then I progressed from there. I moved for 2 or 3 different banking institutions. Had an opportunity to go in my first senior position working up in northern Maine in 1997, and that was kind of far from home. And an opportunity in the credit union world came up, actually for a president CEO. And my father sent me the ad from the paper, which he never would usually do. And he said, you need to apply for this and come home. So I was fortunate enough that's when I stepped over in 2000 into the credit union movement. And I worked at that credit union for 7 years before I came here to Maine Savings 16 years ago. So it's I enjoy being in the credit union space. It's kind of what banking was when I got into it back in the early to mid 80s. When it was more community focused and community oriented. And so I really enjoy being my background, educational background is business management. And it was I really enjoyed being in an industry where I could help people meet their financial goals and needs. And it's been just a great ride. And I've been fortunate to have a lot of success passed my way and had an opportunity to progress in the industry and really love what I do every day. Because for me, it's all about making a difference in people's lives, whether that's your coworkers or your members in our case, and trying to leave everything in a better position tomorrow than it was when you found it today.
That's a great story. Love it. And the ad from the paper is great. I don't know if that would still work. Would that be a LinkedIn post now or something, Glassdoor? I don't know where you would.
Yeah, would be. Little slip of paper. He cut it out. It was like a 2x2 ad, and he cut it out and he put a sticky on it and said, apply for this. And then he just mailed it to me. Didn't tell me he was sending it. And then I'm like, okay, Dad, I'll do what you say. And it worked out great. Yeah, it worked out great.
No rationale, just like, son, it's time.
We want you back home. We were expanding our family at the time, and it was 5 hours away. And he's like, it's too far to drive on the weekends to see the grandkids. You need to come home. So that worked out well.
So I'm curious how you think about right now managing, we're experiencing it like maybe one of the most volatile periods in banking, that most of us have experienced, right? I feel like I've got whiplash from a couple of years ago. I was getting calls from everybody going, Jeff, we got too much cash. Help us out with that. And then that's not the call I get anymore. I go, Jeff, we don't have enough cash. We got to stop all of the stuff we're doing. We need some cash. So how do you think about how credit unions can optimize portfolios? Like, how do you manage through that cycle and prepare yourself to be ready for what seems to be a more turbulent set of times than most of us experienced over the last number of decades, where there was, I would say, a little bit more stability than what we've seen. The rapidity of change seems to have really increased.
Yeah, I mean, it's a great question, and as I think about that, It's been, as you mentioned, it's been a number of years since we find ourselves in a situation like we do today. And in many cases, perhaps folks that haven't been in the industry more than 15 or 20 years have never experienced anything
It's their
like
first time around, yeah.
So, yeah, and that makes it even harder because you don't have that experience, to draw on. One of the things that we try to do is try to create symmetry throughout our balance sheet. Obviously, we know that you're going to have to be mismatched somewhere along the way. You're either going to be asset or liability sensitive. You need the opportunity to leverage that and make money. Certainly, 2 years ago, I think we would have been hard pressed to find anyone in the CFO role across the industry that would have predicted that rates would have gone up, close to 500 basis points inside of 15 months. And so being able to anticipate that and prepare for that is kind of difficult. But what we've tried to do is balance across the assets and liabilities as best we can. Our philosophy has always been to try to match assets and liabilities to the extent that we can. There was going to be a little bit mismatched, but take those liabilities and put them into somewhat like assets or something that will be a mitigant when it comes to risk, right? We don't speculate on what could happen tomorrow. We try to make decisions today that are in the best interest of the institution and our members based on what the circumstances are today. And I think, when we look at some of the issues that have gone on here recently, and obviously SVB is on top of everyone's mind, when you look at what the issues were there, and there's obviously a lot more to the story than what I'm privy to or what most people are privy to, but the bottom line was they took low-cost, short-term assets or no-cost liabilities, and they tried to, leverage the spread and buy long-term, high-yielding assets. And then when the markets turned to the degree that none of us could have predicted, now they're in a situation where in order to meet that demand, they can't afford to raise their deposit rates, so they're going to meet that demand for deposit outflows because their borrowers are looking for higher returns. You got to liquidate your assets, and now you're doing that at a substantial loss. So we try to be, obviously you give up a little. You don't want to chase yield. We want to obviously earn as much as we can on our excess funds and our investments, but we feel it's appropriate to maintain a balance there that makes sense, so that you don't run into that situation. In the short run, you're going to make a little bit less money, but you're going to take a whole bunch of risk off the table as well. How
do you think about, you talk about buying like assets to the liability, matching durations and things like that. And one of the questions I have is how you think about the duration of deposits of various types shifting. Because one of the big surprises to me, I think for everyone in the SVB, was just how fast deposits, like how correlated the outflow of deposits could be. And they saw like 25% of deposits outflow in a day. And I don't think many of us are prepared for that. And I think we thought of them as stickier. And so I'm curious how you think about the shifting nature of like what is the nature of the duration of a deposit? How sticky is that? Is that shifting in your mind, and how do you adjust that? Because it feels like there was a bit of poor risk management there for sure in terms of buying long-term treasuries at 1.7 or whatever. It was not a good play. Interest rates were certainly not going down, and you were giving yourself big interest rate risk. But there was also a degree of like traditional run on the bank, and just the speed at which it could happen was kind of unprecedented, and left them really in a way that, given 6 months, they probably could have handled this in some better way. But given 24 hours, right, there was nothing that could be done for that. Yeah, and I think that changes the way we have to think about what a deposit looks like and what it means, and how long term it might be when we're trying to match it to an asset.
No, that's absolutely right, and it's an excellent question, and certainly nobody could have predicted that they would have the run that they had in such a short period of time. We run, obviously, as I would assume most people do, with our ALM modeling, we run all kinds of what-if scenarios. And honestly, for a number of years, myself and others have asked the question, how realistic is it that we're going to see rates change 300 or 400 basis points overnight, and we're going to have a run and we're going to lose 10 or 20% of our deposits in 30, 60, 90 days. And it's easy, like I mentioned previously, when people haven't gone through these cycles before, it's easy to say, that's not going to happen. But if we look back now over the history of the last 15 months, it did happen, and then some. And one of the things I'm always cautioning our ALCO on is the fact that, hey, we do a 300 or 400 basis point shock test. Well, when I do that today, it's the equivalent of doing an 800 basis point shock test 15 months ago, because rates have moved 500. And now you're shocking an additional 3. And, how are you going to look there? So we obviously do what most people do. We do decay studies, on our deposits, and we try to look at how they've performed not only over time, but during various economic cycles and those kinds of things. And hopefully what's happened in this kind of a situation before is somewhat predictive of what might happen in the future. But I think a lot of it boils down to the trust that you build with the members that you have. And I actually think that this could provide, of course, time's going to tell whether this theory proves true or not. But I honestly think that we might have a little bit of a flight to safety here. And I think that credit unions in general may be picking up deposits as we move forward over the next several months, just because now, all financial institutions are stained by what's gone on with the recent losses, right? Because we're all painted with the same brush. But I honestly believe as well that just like when the stock market ebbs and flows, there can be a flight to safety when the stock market's going down across the financial industry. I think this could be something that pushes members or consumers and pushes deposits towards credit unions. So that could be something that alleviates what is currently a liquidity situation going on for most. But it's hard. It's hard to figure out. It's easy to have the glass ball now and say, well, we know what's going to happen, right? And I've said to other members of our staff and to our board that, had I known in January of last year what would happen with rates, I probably would have gone out and borrowed a whole bunch of money and locked in those 1% rates for 4 or 5 years.
And we just bought U.S. Treasuries.
Right? We'd be looking fantastic. But
yeah.
The problem with that at the time was if I go out and I buy these investments or borrow this money and I'm paying 1 or 2% and I'm earning 0 overnight, that's a huge risk. I've got to pay that. I've got to pay for that. And then if rates don't change, now I'm a little bit of a chump. So that goes back to, my comment before that we really feel we need to make the right decisions every day based on what's going on in the economy today. Not necessarily, we certainly want to look ahead and try to predict as much as we can what we think could happen in the future. But I don't think we can bet our future on the fact that is going to happen, because it may not.
How do you think about, you talked about the possibility of C's picking up deposits in this kind of flight to safety. What's your advice for a credit union, a community bank? I won't limit it to credit unions. We have people who listen from both. But if you want to look like, in some ways, I feel like the safety feels like the big four, right? You go, well, these guys are almost for sure going to pick up a government guarantee of deposits, maybe even uninsured in the case because they're systemically important. They kind of almost an implicit unlimited FDIC insurance against those guys. And so that feels like the natural form of safe. But I think you could be onto something that smaller institutions can feel like a safe bet as well for a lot of businesses and consumers. What's your advice on how to feel like that safe place in a storm if you're not one of the big four with this kind of SIFI indication that the government's really going to make sure that nobody working with you gets hurt in the end?
That's a great question. I think we over in our market have worked very diligently to develop a strong brand and become seen as a trustworthy institution. I think transparency is important whenever we have the opportunity, whether it be through social media, print media, annual meetings, whatever it may be, newsletters. We try to be as transparent as we can and put the message out to the member, always trying to educate them on what's going on in the industry, how that impacts us, how we're positioned, what our philosophy might be in terms of how we handle, certain situations. And obviously in this case, with liquidity being on everybody's mind right now, we tend to be as proactive as we can and get the message out that in a positive way, not just promoting ourselves, but in promoting the industry in general. Here's questions that you need to be able to ask. Here's things that you can do to protect yourself. And kind of be an educational front, if you will, for those folks that have questions. And certainly we've had members over the last several weeks that have called with questions. We have a good portion, probably not a substantial amount, but probably 10% of our member deposits, 8 to 10% of our member deposits would be considered uninsured deposits. And so a few folks have had some, concerns. We have looked at how we can add excess share insurance, and in some cases for certain programs we've done that. We also educate the members whenever we have the opportunity on how you can structure your accounts so that you can get more out of the FDIC or NCUA insurance, which is possible to get substantially more than the base $250,000 there if you structure your accounts in the right way. So it's really about education, and we just try to, like I say, we've got a really good reputation. We've been in the market since 1961, and we've always remained profitable. We've remained strong, and I think that the members know that they can trust us when they have questions. We're willing to answer those questions completely and with full transparency. So, I think that helps. Like I say, there's always whenever there's bad news, it kind of impacts everyone, right? If there's positive news in the industry, it kind of falls on deaf ears most of the time.
Well, it's a bit like the intelligence agencies, right? Like when you're managing it well, nobody's paying attention until something goes wrong. And
Right.
I thought this was one of the most ludicrous lines of reasoning after SVB was like that the line of defense was supposed to be the CFOs of the businesses that were banking with these guys, looking at the balance sheet to make sure they were putting their deposits at a bank that wasn't taking risky bets. And I don't think when things are normal, the CFO of very many businesses is looking at the balance sheet allocation and is there interest rate risk at in the investments that my bank is making, and should I move my deposits because of that? I thought that was kind of silly because to your point, like people aren't really paying attention, but maybe in this moment being a bit more of a dull and traditional. I mean, dull is maybe the wrong word, but you talked about the credit union space being the kind of back to basics version of banking that community banking was. It might be a strength when times get turbulent that you're sticking to, not trying to make an excess yield and you're doing the basic banking stuff that is a little more stable through thick and thin.
Yeah, I honestly believe that. That's why I talk about, the flight to safety. The unfortunate reality that I think we all know is that whenever something bad happens in the world, no matter what it is, there's always a massive overreaction, right? And so the concern that we have is from a regulatory standpoint that, and rightfully so, the regulators should be focusing on these things. But what will typically happen now is there'll be a massive overreaction. They'll want to see even more what-if analysis and stress testing through the ALM model. They're going to want to see, obviously, less risk, and it's just going to be on and on and on. So even though an institution may have a long track record of performing in an extremely safe and sound manner with great controls and practices and is doing everything the way that they should to continue to be successful, there's really no leeway going to be given there. It's still going to be, we get treated with the same brush as everyone else. This went wrong over here, so we assume that it's going to go wrong with you, and so therefore we're going to be even more. We're going to put even more of a regulatory burden on you, and that's difficult because with everything that we are dealing with, I mean, it's appropriate that they should have the right controls in place, and we should operate within that framework. But I think a real concern for us and others is that now we're going to go way the other way. Should this have happened at SVB? Probably not. And the fact that they had, there's a certain amount of blame that can not only be placed on the management there, but also the regulators to a large degree. They're in the shop on a regular basis and they see what's going on. And it's easy to be a Monday morning quarterback, right? Look back and say, oh boy, that was a bad decision. We shouldn't have done that. Everybody makes mistakes. But so that's a little bit of a concern for us. We have a great relationship with our regulator. We've always been considered strong, safe, and sound. And that will continue to be the case. But I know that there's going to be even more of a burden in those areas. And that kind of takes away from what we can do for our membership in terms of it takes time, it takes money, it takes effort. And that takes money and time away from what we can do, to assist our members with the programs that they want to have.
So let me ask you a related question, which is into something you said earlier, which was kind of this like the liquidity crunch that people are experiencing. And, when you talk about the back to basics, it's really about, I find so much of credit unions, one of the things I enjoy is it's really about serving the members. I mean, there's not this kind of asset purchase, yield seeking. There's a little bit more of like, how do we use our deposits to serve the products that our members need? So truly kind of like balancing the two. But obviously, the needs of your member base can be shifting in a different way than your deposit base may be. And so, how do you think about managing, serving the needs of the members in terms of products and lending things, services they may need with the liquidity situation as it is a little bit more volatile? Because it feels like those two things can get out of balance, and you're trying to really serve both.
Yeah. That's absolutely right. I think, the last few years, say 3.5 years now, pre-COVID to today, our industry has been through really an unprecedented time. What we found during COVID was that we had this massive influx of cash and liquidity, and I think that's probably true for most institutions. You had the PPP going on and all of the government assistance programs that were out there, and people were receiving all this funding. Businesses were receiving large amounts of funding, and obviously that's stopping, at their local institutions. So we saw our liquidity. We saw record high liquidity during the front part of COVID, and the assumption was that that's going to be temporary. This money is going to be spent down, and it's going to go away. So we wanted to make sure that we continue to keep those funds available so that it could flow out as easily as it came in. It turned out that really wasn't the case. For the most part, I'm sure some of that money flowed out, but because of the growth that we're going through and attracting and acquiring new members, we really didn't see our balances roll off. We ended 2021 with, in excess of $100 million in cash, and at the time we were under $500 million in assets. So that was, fairly substantial, and we're earning zero on that money. So we put together a plan. We said, we know members are going to need. There's going to be. We moved through this COVID. We know there's going to be a demand, and members are going to want to get out. They want to spend money. They want to buy cars, or whatever they may want to do, with interest rates being as low as they are. And we're earning zero on that money. So let's get aggressive on loan growth. And we put together some really aggressive loan growth programs for 2022. I think we budgeted to grow loans about $80 million. We actually ended up growing loans about $110 million. And we were still bringing in cash, so obviously our cash balances were going down, and then the ALM model suggesting, hey, you can't continue to grow loans at this pace, obviously. And we weren't bringing in deposits at that pace. We only bring in deposits maybe at half of that speed, which was by design. But then rates start to go up, right? So throughout the year, we're getting this money out there, but then we're getting to a point where it's like we don't want to be too aggressive on pricing now, because you can actually earn equal to or more than what you were pricing some of these loans at. And so you leave it in cash, and you don't want to take the risk. But going towards the fourth quarter of last year, I looked at this situation and said, we want to prepare ourselves for continuing to grow in 2023, and we need to replenish some cash. So we actually got really aggressive, and we went out there with some very attractive certificate special offers. At the time, we were offering a 50-year 5% CD, which was, I was told, was the highest rate in the nation at the time. Whether that's true or not, I'm not sure. But it was certainly very attractive in the marketplace. We knew we would bring in a substantial amount of cash. We knew we would cannibalize some of our own deposits that have been sitting on the sideline in low-cost deposits, waiting for rates to go up. But we were willing to do that because a couple of things. I knew that I could go out and buy institutional investments at or above that rate for terms 12 to 18 months, and we were happy to do that. And then in worst case scenario, we're earning somewhere around 4.6 at the time overnight. So we're only giving up maybe 40 basis points on the spread. And the flip side to that was we said, this gives us an opportunity to bring in new members. And it gives us 50 months to cross-sell these new members and make us their primary financial institution. So part of our strategic plan to grow and continue to grow in 23 was exactly that. We backed off of our loan growth goals. We focused on deposit acquisition. And we said, we're going to put together a plan that now allows us to deepen the relationship with these members. Our history has shown that typically we're very successful doing that. When we run certificate specials, we always bring in hot money. Certainly some of that leaves when the certificates mature, but we've never seen our balances go backwards. So we've always been able to replace that hot money as we bring in these members and deepen the relationship. So that kind of was our strategy. I was obviously concerned as a person that's responsible for running the ALM model and making sure we have adequate liquidity and knowing what was going on in the industry. And I said, let's just get out ahead of this as quickly as we can. Let's try to bring in a bunch of money. In our market, I think we did really well. I mean, we brought in, $40 or $50 million in new money in 3 or 4 month period. So that was huge for us. And now we're well positioned. Again, we've got a ton of money in our overnight account. We've got strong loan growth continuing, way over budget so far in the first quarter. But it positions us well to operate from we're positioned to operate from a strong foundation and continue to be able to offer what we need to our members. We may make a little bit less money because we've taken on that extra expense, and certainly we did have more money transition over from the non and low interest accounts into the CD, but that's okay because now that money's sticky, and with loan rates continuing to increase, we can still make a positive spread there and leverage the volume to still generate some money on the bottom line. Obviously, we've got to continue to support the capital ratio as we do that.
All right, one more question for you. In times of volatility or times of, I feel like so often in times of difficulty, there's like hidden opportunity, right? It's kind of a moment where, what's the old Buffett saying? When everybody else is nervous, get greedy. When everybody else is greedy, get nervous. So a lot of people are nervous, and I'm not trying to say you want to be greedy, but what do you think the hidden opportunities are? Like, what are the things you're saying, hey, this is a moment that we can take advantage of in certain ways while we're obviously being cautious and conservative in others? What are the kind of hidden opportunities in the current environment?
Well, I totally agree with that. And I think certainly over the last 10 to 12 years, that's kind of been our MO, if you will, is we look at, what's going to be coming down the road over the next 12 to 18 months and how can we take advantage of that? And there's going to be, our history would show that there's times when loan growth is there to be taken, and we've gotten aggressive in that way. Other times when it's like, okay, we need to back off on that. Loans are going to be relatively flat now for the next 12 months. And we're going to focus on the deposit acquisition. So the opportunity, I think, goes back to as rates have ebbed and flowed and liquidity ebbs and flows, we try to tie our strategy to what's going on and what opportunities does that create. So when we're flush with cash and overnight rates are relatively low, we came out with a very aggressive, we had a 50% off promotion where we basically said anything that's non-real estate related that you hold elsewhere for debt, you come see us and we will cut your rate in half. And certainly that led to us writing some loans at rates that were slightly below where our traditional rates would have been. But now, to folks out there that are consuming financial products, they say, wait a minute, I can cut my rate in half. That was very attractive and very successful. And we ran that promotion for 3 or 4 years. It's a little harder to do it now. We're still kind of trying to figure out. And obviously credit cards is a perfect scenario. Yep. Our top rate on a credit card is 10%, basically 9.99%.
Wow. Yeah.
Which is already 50% off of more than 50% off of what folks are probably paying if there's
typical rates are 20, 25, 20, 28, something like that.
So we've tried to leverage that a little bit, and then obviously as things ebb and flow, we will come out with some deposit specials that make sense. But in both cases, whether we're attracting loans, we say, okay, we want to bring your loans in, and then we're going to work on you. While we've got your loans in here, we're going to work on explaining to you and selling to you why our other financial products and services make sense, right? And I think like most credit unions, we don't charge any fees. You've got full service. Everything that you need to consume, you can consume here, and you're not going to pay any fees. So if we're bringing in new loan members through new loans, then we're going to focus on how do we now become your PFI on the deposit side and provide some of these other services. And then now, while we're bringing in the folks on with higher deposit rates, now that gives us a period of time to say, we want to sell ourselves to you and explain why we should be your primary financial institution. And this is what we believe in. This is what we care about. We really care about your financial well-being. And then the other piece of that, which I think is really important, and I think most small financial institutions would take this tact, is we don't want to sell you anything that you don't need. It's not about how many widgets did we sell today? It's about how many members did we assist? How many members' lives did we make better tomorrow than they were today as a result of what we're able to do for them? So it kind of ebbs and flows based on what's going on in the economy and what our most important initiatives are. But that's we're always looking about how do we deepen the relationship.
How do you think about, I want to dig in on that because I think it's such an important point, this difference between how many products did we sell, how many, and did we find the right products and serve the members' needs? And how do you think about creating a culture and measuring that? Because it's so often what the old manager is saying, whatever's measured is what matters. And what's measured is typically like units, sales, like it's the thing that's easy to do. And like, was that the right thing for the customer or not? It's harder to measure. Like, did we really serve the customer's needs? So I'm curious how you think about both either putting measurements on that or at least instilling that understanding and culture into your team members, especially as they're out there maybe with comp plans that are against sales targets or other things. How do we really get people to focus on serving the members' needs above hitting some target or growth? Because that feels like the right thing to do, but also a hard thing to get the organization centered around doing, just from an incentives point of view.
Yeah, absolutely. It's extremely difficult. One of the things, and we're moving down that road all the time to say, how can we do that better? We've kind of moved away from incentives over the last few years. There's a couple of products that we will still incent, our loan officers and our MSRs to sell to the members, ancillary type products and those kinds of things. But when it comes to goals and objectives, we've tried to steer away from giving somebody a hard goal. We know what the expectations are. We explain to all of the staff that are in production roles, this is what we would hope for this position that we can generate for volume. But we don't focus on really, we give feedback, obviously. We let everybody know what the production, how we're doing for production and what the numbers are. But we don't focus on, hey, how come you didn't sell this many loans last week, or you didn't bring in that many deposits. Now we're transitioning. We're actually going to a key performance indicator type system, if you will, or mentality that we're introducing across the company now. And we're saying these are the things that are most important to us, and this is going to determine, potential bonus payouts or a number of different things on the incentive side. So rather than saying we're going to give you $5 for every checking account that you open or whatever it might be, we're saying two things that we came up with only two KPIs this year. One was the most important one is we want the member feedback. So after a member transaction occurs, could be a new member, it could be an existing member. After certain transactions, the member would receive a survey from us that says, tell us how we did. How well did you feel that you were served? And they are able to rate us on that. So that's one. The other component, because we want to tie this in across the entire company, is we have an internal component for that. How well were you served by your coworker? How well was the folks on the front line served by the back shop department when they needed to be, and those kinds of things. And so we're using those right now as measures. And we honestly believe that that kind of feedback will make us better. We want to enhance the member experience internally and externally. And if we do that and we become known, we have a strong presence now, and I think our members rate us highly in terms of the service. But we're trying to say, how can we be better? How can we be better tomorrow than we were today? And how can we make that a positive experience for you? So with that feedback, we're able to address maybe we have issues where our process is not as member friendly as we think it might be. And we'll be able to assess what the difference between what we feel is important to the member and what is really important to the member. And then we can adjust our processes accordingly. So we still have the appropriate controls in place, but we're able to now push it back to the member and give you the experience. So you leave and you say, wow, that was fantastic. And not only do you want to bring all the rest of your business to us because we treat you so well, but now you're going to go out and tell all your friends, hey, you really need to go see Maine Savings because this is what they're going to do for you. So we're trying to get away from the whole stigma, if you will, of you need to sell X amount of whatever it might be. From a pricing standpoint and a product standpoint, I think we structure ourselves in such a way that those things are easy to sell and they're attractive to buy. And like I say, we don't charge fees. Use and abuse fees is really all we have for fee income. The biggest one being overdraft, obviously, which is really the only punitive fee that we have on members. All of our account services are free. And then obviously on the use side, we're generating a fair amount of interchange income, which is important. It's free to the member, obviously, but it's obviously makes a big difference on our bottom line. And we're working on how can we enhance other revenue sources so that we can potentially, we see the writing on the wall, reduce and eliminate what revenue is coming in for overdraft. So we're trying to look at options for how we can potentially provide some additional services that members may even be willing to pay for. We're not requiring them to pay, but there's some additional, just like a subscription service that you can, just like the TV stations and everyone are doing now. Hey, for $9.99 a month, you can have all of these benefits if they're important to you and they have value to you. Maybe you'll subscribe to those type of things. So that's kind of the approach we're taking, and we have established, what we call Maine Savings Academy. So all of the folks, we want to create career paths for everybody, regardless of what level in the company they're at, so they feel there's opportunity to grow and expand. So there's required academy classes for people to continue to progress in their career. There's optional classes that go along with that. It's all about educating them so that they understand all of the intricacies of our business as best they can. The better that they understand how everything fits together and how vital they are to our success, the better job they can do. So it's more about empowering them and educating them and supporting them and providing them with the tools that they need to be successful, and then having a system to say, this is the feedback we're going to get. Your members are the ones that are going to tell us how well we're doing, and that's going to determine what we may have available for incentives, for example. So getting away, because we know that if we do those things right, then the business will come. All of the business that people want to consume will come to us. And it's not about just selling something that they don't need, because eventually they learn to dislike you for that. That becomes a disincentive for them to want to come in and do any business with you. Because like every time I go in there, they knock me over the head and they're trying to give me this stuff that I just don't need. So really understanding what their needs are and trying to find a way to deliver everything to them is kind of the way we go about that.
Love it. That's great advice, because it's such an important thing to be able to do, the organization to really execute on. Dave, I got 3 questions I ask everybody at the end of this podcast. I'd love to ask them to you now, because I think we're about out of time. And they go like this. Number 1, what's the best piece of career advice you've ever gotten?
Oh, that I ever got.
Or Dave, if it's something that you give all the time, that works too. But best piece of career advice.
Well, certainly I think the best advice that I try to give to the folks that I work with is to be honest always, to let people know what your expectations are, what is acceptable for behavior and effort, and what is not acceptable for behavior and effort, and to lead obviously by example, not to be a hypocrite. If you say this is the standard of excellence and commitment that I expect from you, then you should demonstrate that in everything that you do. And I always tell folks that you only ever get one chance to make a first impression. So make it a good impression. And it could be, we had a live situation here recently where one of our tenured employees has been promoted into a management position. And she's in the same location where she has been for a period of time. So she's now leading the team of which she was a coworker just last week. And I said, you still have a first chance to make a first impression as the leader. They've come to work with you and they know how you do what you do, but now you've got an opportunity to make that distinction. So, and then I think you do that, and then you say what you expect, you do what you say. You have to always try to lead from the front and let people know that you have their back. I always say, as a leader, when there is praise to be had, you share it with the team. You deflect it to the team, I should say. When there's criticism to be had, you accept that and you take that on your shoulders. You don't publicly berate anybody that you work with who may have been responsible for that negative feedback. Maybe you have a conversation with them in private. But from the team's perspective, they get to know, here's somebody that I can trust. I'm going to walk through a wall for them because, they give me the credit that I deserve and they protect me when they need to protect me. So that's the best piece of advice that I can give to somebody that's, working into a leadership role. And what I've tried to do over my career is everybody's a little different. Everybody works a little bit different. And there's no right way or wrong way necessarily to get to the objective. But what I've always said to people is, whether you're working side by side with someone or if you're working with somebody that's under you or above you, take what you like and expand on that. And if there's things that you don't like, don't focus on that. Just let it go and don't recreate it, and you'll become better. And then always strive to, as I've said before, always strive to be better tomorrow than we are today. We can always do things better. And always, the last thing I would say on that is, just because I might like to do something a certain way doesn't mean to say it has to be that way. We always want to become more effective and more efficient, but it doesn't necessarily matter to me how my teammates get to the end result. As long as they're operating ethically and efficiently and it's not creating issues, why should I stymie their creativity? I encourage their creativity. It doesn't have to be the way that I would necessarily do it. And so those are things that I try to tell folks. Hey, be your own individual self and be the best version of yourself that you can be.
Love it. It's a lot of wisdom packed there in a minute or two. Second question I typically ask is, what's the best piece of advice you've gotten or that you give about the consumer banking space in general? Like, what are the kind of key things you've learned or advice you've gotten about just operating in that space?
Well, I think certainly the message that I would want to deliver is that it's a people business, right? And I think the struggle that you have as you get larger, and certainly some of these larger institutions, it's just impossible to have personal relationships. Even when I worked for some of the national institutions, you could still have, because of the way that processes were established and the control that you had at the branch level, you could still establish some of those personal relationships. I don't think you can do that. It's been a long time now since I worked in one of the what I consider a large organization. But my guess is that there is very little personalization. There's not much that can be done at the local level in the local branch. It's all structured. It's all centralized. There is no control. You're basically a glorified order taker, and then you just, the member may get what they want, but they don't get a relationship. And so I think in the community banking space, in the credit union space, a huge differentiator for us is the fact that we can, in fact, engage with our members and establish relationships. We have a leadership forum every week where we have our senior staff and middle managers and retail managers on a call to discuss what's going on across the company and best practices and what's working well or issues that we may have. And, one of the things that one of the managers mentioned this morning was it's great to be able to sit with a member in my office and I establish a relationship with them. And it's not about selling them a particular product or service. It's about understanding what their situation is, what their needs are, and how we can help them, meet those needs. And sometimes the member doesn't always know exactly what they need. They might have an idea of what they need, but we need to spend time listening to what they have to say and understanding their story, and then explaining to them how we can make things better for them tomorrow than they were today.
Excellent. And my last question is, what's one bold prediction for the future? It's a scary time to make bold predictions, I feel like, yeah. But there it is. A bold prediction for the future might be that our credit union will become the largest credit union in the state of Maine. We're not currently. We're up there in the number 2 or 3 position. I like that one. That's a great one. A little ambition in that bold prediction.
Yeah. Several years ago, our long-term CEO that retired at the end of last year at a company training day made a bold prediction and said, he gave us a BHAG, and he said, we want to be $1 billion credit union in a certain period of time. And back at the time, we were, this was probably 5 years ago or so, we were maybe 350 million. And it seemed like forever away to be able to reach that kind of an objective and to do it organically, right? Not through any mergers or acquisitions or anything like that. And now we sit here, 5, 6, 7 years later, and we're 650 million, good chance we could top 700 million this year. And it's like, well, that's not so far away now. And it's not, we've always preached that it's not a matter of size doesn't really matter. I mean, we know in our industry, in order to be continually successful, you have to grow. But it's not growth for the sake of growth. And you need to approach it the right way, do the right thing, and things will work out as you move forward. Slow and steady, as they say, wins the race, right? So I don't know that answers your question necessarily, but
I think it's great.
I think the last thing I would do is I'm going to put in a plug here because somebody asked me, what can we do? What might we do differently, and what opportunities are lying out there that can assist us to get where we want to go? The financial services pie is a certain size, and so the only thing that you can do is try to get a bigger piece of the pie, right? It's not really, in general terms, it's growing a little bit, but let's assume you have one big pie there and everybody's buying for a piece of it. How do we get a little bit more, and how do we maybe overcome some of the challenges we have with increasing costs on the deposit side and narrowing margins, for example? So for us, we said, we want to get a larger share of unsecured lending. We know that there's higher yields there. If we do it the right way, we can mitigate the risk that goes along with that. So we chose to partner with Upstart as a fintech to say, look, these are a whole bunch of loans here that we're going to be able to get, and members that are going to be able to come to us that are going to be good loans that are going to have a high yield and help us with that margin compression. And ultimately, these are members. One of the points that I made to our leadership team was, these are loans to folks that we would not be seeing if we weren't in that space, because these are folks that are going to achieve what they want for financing without walking into a location anywhere. They're just going to go online and they're going to find out the best deal, and then they're going to get an offer, and it's going to be, through Upstart with Maine Savings, and everybody's going to be happy. So, and we honestly feel that after doing our due diligence, we think we're pretty good in the lending arena and have been for a long time. We think there's a huge opportunity in unsecured lending, and there's no doubt about the fact that, working with Upstart and your unsecured loan program, we can get not only access to members that we wouldn't have access to, but in most cases, if not all cases, because of the intelligence that you use to underwrite, you're going to make way better credit decisions than what we make. And we don't have the fixed overhead now that we would have attached to lending staff to say, we're going to bring in 2 or 3 loan officers that may find some loans. By partnering with the fintech, and there's other companies out there that do, offer additional services, we will need to have additional revenue. And the struggle that we will look at is, how can we replace some of the revenues that are going to go away, and the challenges that we have with those going away, which is substantial. How do we offer additional products and services that can help us replace that revenue that will eventually go away? And certainly the program we have with you guys will help us do that. So we appreciate that.
Well, Dave, I appreciate the plug, and hopefully we can help you become the largest credit union in Maine. I think that was the bold prediction, so I like that. Thank you so much for joining me today and sharing, I think, a lot of insightful perspectives. I really appreciate you making the time.
Yeah, it's been my pleasure, and we appreciate the opportunity to spend some time with you guys. We're looking forward to continuing to work with you as we move forward.